The pursuit of financial success and wealth creation often drives individuals to explore innovative avenues that go beyond conventional boundaries. One such area of expertise is the art of tax optimization, the practice of legally and strategically reducing tax payments. In this video, we will reveal the methods and strategies they use to minimize excessive tax payments. From reinvesting profits to relocating internationally and employing creative asset ownership, this examination sheds light on the dynamic approaches the wealthy use to protect their wealth and boost their financial growth, all while staying within the boundaries of the law. But before that, let's enhance your financial knowledge and join the ride on the Riches Roadmap channel. If you're ready to improve your budgeting skills, set financial goals, and work toward financial freedom, hit that like button and subscribe to our channel. Don't forget to leave a comment, ask a question, or offer a suggestion about our videos, because we genuinely enjoy interacting with you. And now, let's get back to the topic: how the rich avoid tax payment. Real estate investment. Real estate investments offer several tax advantages that can help rich people optimize their tax liabilities. For instance, through depreciation deductions, wealthy individuals can deduct a portion of their property's value over time, even as the property's value appreciates. Additionally, the like-kind exchange, or the 1031 exchange provision, enables investors to defer capital gains taxes when swapping one investment property for another similar property. For example, if an investor sells a rental property to purchase another, they can defer the capital gains tax on the sale, allowing them to reinvest the full proceeds. Moreover, deductions for mortgage interest and property taxes can help reduce taxable income, while rental income deductions cover various property-related expenses. These strategies, along with a favorable capital gains treatment for long-held properties, make real estate an attractive avenue for potential tax savings. Tax-deferred accounts. Contributing to tax-deferred retirement accounts, such as individual retirement accounts or IRAs or 401ks, can have a significant impact on reducing wealthy people's current taxable income. These accounts allow them to save for retirement while also providing potential tax advantages. When they contribute to these accounts, the money they invest is deducted from their current taxable income, meaning they don't pay income tax on that amount in the year they contribute. Instead, the money grows tax-deferred until they withdraw it in retirement. For instance, if they earn $60,000 in a year and contribute $5,000 to their 401k, their taxable income for that year becomes $55,000. This means they'll pay taxes on a lower amount, potentially putting them in a lower tax bracket. Additionally, any investment gains within the account are not taxed until they withdraw them in retirement. This allows their investments to potentially grow faster over time, as they compound without the drag of yearly taxation. Capital gains. For the wealthy, how capital gains are treated in real estate offers significant tax benefits. When you sell a property you've owned for more than a year and make a profit, that profit is called a capital gain. Capital gains are split into two main categories: short-term and long-term, depending on how long you own the property before selling it. With long-term capital gains, which apply to assets like real estate held for more than a year, the tax rates are usually better than the regular income tax rates that typically apply to things like salaries and wages. The exact tax rate for long-term capital gains depends on how much money you make and the specific kind of asset you sold. As of my last update in September 2021, the highest tax rate for long-term capital gains for most people was 20%. But people with lower incomes might even pay no taxes on their long-term gains. To give you an example, imagine someone bought a property for $200,000 and then sold it 3 years later for $300,000. In this case, the capital gain would be $100,000. If the person qualifies for the 20% long-term capital gains tax rate, they would owe $20,000 in taxes on that gain. This is much lower than the potentially higher taxes they'd have to pay if the gain were treated as regular income. Invest all of your money. Wealthy individuals understand the importance of effectively utilizing their money. They avoid letting surplus funds sit idle. Instead, they strategically direct these funds to achieve the best possible returns. This strategy is based on a fundamental tax advantage. Profits that are reinvested remain untaxed. Here's how it works. When a business makes $5 million in profit and chooses to use that amount to expand the business, it avoids being taxed on that $5 million. The foundational principle becomes a catalyst for rapid business growth. It not only increases your overall financial value, but also acts as a shield against higher tax obligations. Through consistent reinvestment, a cycle of growth and accumulation of wealth is established, unaffected by the burden of tax liabilities. Move to a place with low or no taxes. Indeed, many wealthy individuals opt for relocating to regions with favorable tax regulations as part of their strategy to optimize their financial situation. This tactic is known as geographic arbitrage and can lead to significant benefits. Certain places like Monaco, the Cayman Islands, or Dubai are recognized for their exceptionally low income tax rates, or even complete absence of income tax. While the cost of living in these areas might be higher, the reduction in tax liabilities often outweighs the expenses. This strategic decision empowers wealthy individuals to keep a large portion of their earnings, which accelerates the growth of their wealth. By thoughtfully selecting a jurisdiction with friendly tax policies as their new residence, individuals can legally reduce their tax obligations, facilitating a quicker accumulation of wealth over time. Go global with your money. Big multinational companies like Facebook, Google, and Apple are really skilled at using the strategy of international tax efficiency. They create branches in countries with good tax systems, like Ireland. By holding their intellectual property in these branches, they legally move their profits and lower their tax bills. They do this through licensing agreements between the main company and its foreign branch. This shows how clever wealthy people are in navigating global tax systems to their benefit. Engage in charitable contributions. Getting involved in charity serves two purposes for the wealthy. It's about being socially responsible and also being smart about taxes. When they donate to registered charities, they can deduct those donations from their taxes. This means wealthy individuals can make positive changes in their communities while also lowering how much they're taxed. A lot of rich individuals create their own charitable foundations. This lets them give back and also take advantage of tax deductions. This way, they're doing good and cutting down their taxes, showing how strategic their giving practices are. Choose equity instead of a salary. Wealthy individuals prioritize growing their wealth over getting immediate income. They pick equity over a regular salary. This means they delay when they're taxed until they decide to sell their equity holdings. This way, their interests are connected to the company's success, and they also lower their current tax payments. People like Elon Musk have used this method, which has helped them quickly increase their wealth by being smart about equity ownership. Invest in art. For the wealthy, art is more than just something nice to look at. It's also a way to save on taxes. Buying valuable art can be seen as an expense and might qualify for tax deductions. Over time, the value of art often goes up. When rich individuals give art to charitable foundations or institutions, they can get big tax deductions. This creative strategy shows how smart the wealthy are at using their interests to navigate complex tax rules. The methods and strategies discussed here are not about avoiding taxes unlawfully. They're about using the legal opportunities to reduce tax responsibilities while promoting the growth of wealth. We hope that this video of how the rich avoid tax payment provides not just a window into the strategies of the wealthy, but also serves as inspiration for making well-informed financial choices on your path to success. Thanks for joining us today. If you found this video helpful, give it a thumbs up and share it with anyone who might benefit from it. Don't forget to like and subscribe to our channel, Rich's Roadmap, for more valuable insights and financial advice. Keep taking charge of your finances. And remember, the road to riches is just beginning. See you in the next video.